Hello, this is the lecture on short and medium term financing for international trade. Uh, what we'll focus on in terms of short term financing are the two main methods for short term financing in international trade finance. That's the line of credit, which is generally used by importers and exporters, and then factoring, which is, if you're not in international trade finance, you may not know about it, but it's extremely popular in international trade finance. And in fact, the World Bank is trying to increase, shall we say, its popularity, particularly in some countries that don't currently allow for factoring. When it comes to medium-term financing, we'll look at a method that's similar to factoring, but it's called forfeiting, and then we'll compare factoring versus forfeiting and so on. And finally, we'll just talk about other bank financing methods, particularly negotiated import financing. Okay, far and away the most popular form of short-term financing for both importers and exporters is the bank line of credit. And what the line of credit is, it's a pre-approved amount that the bank essentially will put aside for the importer or exporter, a pre-approved amount that's made available and set aside. And the business essentially at any point in time can draw on that line of credit, that's essentially borrow some of it, and will only end up paying interest on the amount that they've borrowed. And then they can pay it back, and it'll just be sitting there sort of waiting for them. So it's a really flexible way of financing. It's fairly inexpensive because the interest rates that are paid on it are interest rates then that are based off the prime rate. The downside to the bank line of credit is what's called a demand loan. So a term loan, for instance, is where the bank will lend you money for a certain amount of time, the term of the loan, and then you have to pay it back at the end of that. And in between the time the bank lends you money and you have to pay it back, the bank cannot come to you and say, we want our money back. Demand loans, on the other hand, like line of credits, are not like that. With a demand loan, the bank has put aside this sum of money, you have drawn on it, which means you've borrowed some of it. But at any point in time, if the bank is under financial distress, they can come to you and say, you have to pay back all of it, okay, now, because we need the money now. They can demand essentially that you repay at any point in time. So this is the downside, shall we say, to the line of credit. Now, some points then about the line of credit, was saying it's far and away the most common type of financing, particularly for small and medium-sized enterprises, the so-called SMEs. Okay? How much of a loan can you get? Well, it depends then on the company's balance sheet, its profitability, and then of course what kind of collateral you may have that will provide the bank with some degree of assurance that you can pay back. For instance, in most economies, like here in Canada, if you own your own home, you can have what's called a home line of credit, or home equity line of credit, where essentially you can get a line of credit based on the equity of your home, which acts as collateral. And for some SMEs, they can actually, the managers or the owners of these small and medium-sized enterprises may actually use their personal homes as collateral. The other point to note then, the interest you pay on the line of credit is not a fixed interest rate. It is what's called a floating or fluctuating interest rate that's generally based off prime. So it'll be the prime rate plus a certain amount depending on your creditworthiness. The more creditworthy you are, the lower the spread over prime is, and so on. There also are administrative fees that are kicked in that will come in periodically, so you have to sort of be aware of that. The line of credit for small and medium-sized enterprises, they usually, in terms of the collateral that's on there, they usually like to have a certain amount of accounts receivables and a certain amount of inventory, and then they'll be willing to lend you up to 75% of the accounts receivables plus up to 50% of the inventory. And those, in that case, then the accounts receivables and inventory sort of act as short-term collateral. If you have export insurance, and that is your accounts receivables essentially are insured by, say, the Export Development Canada, then that certainly makes it a lot easier for you to get then the line of credit. Now, in terms of the interest you pay, we said you pay then a floating rate, which is prime plus. The question is then, what is the prime rate? And what we can say then is, in terms of interest rates, the prime rate is the interest rate that commercial banks charge their most preferred clients, that is their big corporate clients. And the prime rate then is usually based off the bank rate, the so-called overnight target rate. And here's a chart that shows then the close relationship between the overnight target rate, the bank rate, and the prime rate, which is the blue line that's here. As we can see, in the early 1980s, the interest rates were extremely high. The prime rate was in the mid-20s, so it's about 22-23%, which was extraordinarily high. But over time, it's sort of come down. And over the past, I would say, 50, 60 years, it would sort of have averaged around 4%, 5%, and so on. The prime rate, 6%. These days, of course, the prime rate is very low, historically speaking, and is somewhere around 3 to 3.5%. That's where it sort of fluctuates. So, in terms of the cost of borrowing money, the line of credit then is very cheap because it's based off this prime rate. So here's an example of the line of credit that's there. Suppose a company can borrow a maximum of 100,000, and so the line of credit will have sometimes a limit on it, or the percentage of your inventory and your accounts receivables. So in this case, the maximum amount based on the company's credit worthiness is $100,000. But if it has 100,000 of outstanding accounts receivables and 60,000 of inventory, and there's a 75% cap on accounts receivables and a 50% cap on inventory, then how much can the company borrow? So here's how we'll do the calculation here. We know that you can borrow up to 75%. 75% then, let's see if I can get this. So 75% then times the 100,000 plus 50% then times the 60,000, and this of course then is equal to 75,000 plus 30,000, which is 105,000. However, this amount has exceeded the maximum, so the maximum then of 100,000 and this amount, 105,000, this is the amount you're allowed to borrow, then is equal to the 100,000. And that's then, that's a little weird, 100,000, okay? So this then is the amount then that you are, this is the line of credit. Maximum. Okay. And so that's sort of how you would calculate that. Because this exceeds then the maximum of 100,000, that then becomes how much the maximum you can borrow. So the most you can draw down in any given period then would be 100,000. Now note that if your inventory fell from 60,000 down to 40,000 and you had borrowed this maximum amount, then the maximum that you could borrow under the new conditions would be 50% of 40,000 and 50% of 100,000. Sorry, and 75% of 100,000, which would be 95,000. In this case, your 100,000 that you had previously borrowed, you would have exceeded the 95,000, and then you'd be required to pay down 5,000 of that amount to bring your line of credit into compliance. That is, to bring it within the credit limit. So that's the sort of downside to a line of credit, this fact that it's a demand loan, that things can change. Still, it's a very inexpensive form, and it's certainly the most popular form of short-term financing out there. The other form of short-term financing that's very popular is factoring. And by definition, then, factoring is the purchase of accounts receivables at a discount. And the financer, the person who, or the institution that purchases these accounts receivables at a discount, these are called then factors, the financer. Factoring is actually quite common both inside in local trade as well as in international trade, but it's certainly very important for small and medium-sized enterprises in international trade. It generally involves two steps. The first step is the exporter, essentially, who is the issuer of the accounts receivables. So the exporter essentially sells the goods over to the importer and receives an accounts receivable on their books. The exporter then will notify the importer that instead of paying the exporter, the importer essentially should pay the factoring house, the so-called factor. Okay? And then, of course, the factor will now take on the credit risk. The factor will pay the exporter a certain amount of money for the accounts receivables, and there will be a document that will say that, and will accept then the credit risk, the fact that the importer may not end up paying, as well as accept other risks that are involved. And what the factor does is the factor then pays the exporter a certain amount upfront, okay, based on the conditions. Now, what we can say about factoring is it's, first of all, maybe I should say it's a very expensive form of financing. It's probably the most expensive form of short-term financing out there, but it's fairly flexible, and it's a real easy source of capital. There is a main advantage to it, and I will come to that in just a moment. But the other point to note is that factoring is available on a recourse or a non-recourse basis. And by a recourse, we're saying that if the factor, the financer, purchases the accounts receivables essentially and pays the exporter a certain amount of money for it, for a non-recourse basis, that's the end. Okay. If the importer ends up not paying, then the factor has to absorb that loss. On a recourse basis, what happens then is that the factoring house will pay the exporter a certain amount of money, and then of course we'll have the accounts receivables. But if the importer now cannot pay, then the factor can now go back to the exporter and say, hey, we want our money back because we have this factoring agreement on a recourse basis, which means we can collect our money back if the importer doesn't pay. The way the payment amount is determined is that the accounts receivables, the invoice from the accounts receivables is essentially discounted. And so if, for instance, it's a $100,000 accounts receivable, then the factor knows that's what he's going to get, say, in 30 days. Well, they'll discount that back by a certain percent, usually somewhere between 3 to 8%. So this is very expensive because 3% every 30 days corresponds to essentially about 36% a year, and 5% every 30 days, which is not uncommon, will correspond then to about 60% a year. So it's an expensive form of financing. Now, If it's done on a non-recourse basis, then what tends to happen is that the factor will have what's called a holdback, usually about 20%. And so instead of the factor paying the exporter the entire amount up front, less the discount, of course, the factor will hold back about 20% of the amount until the importer makes payment, and then the factor will essentially pay the exporter that holdback amount. This gives the factor some, shall we say, some of a buffer in case the importer doesn't pay. They have this holdback to act as a kind of collateral. Now here's the main advantage of factoring, and that is that factoring is actually based on the credit worthiness of your trading partner, of the importer. So if you are an exporter and your credit history, your credit worthiness is a little bit shaky, and because of that you're finding it difficult to get a line of credit, well, once you essentially establish a trading partner in another country that has a solid credit rating, then it doesn't matter what your credit rating is. That is, the factor will essentially provide financing based on the credit worthiness of your trading partner. So for instance, if you are able to sell goods from Canada to a company, say like Walmart, and you get accounts receivables from Walmart, well, it doesn't matter what your credit rating is. It doesn't matter if you filed for bankruptcy before. The fact that this is a Walmart accounts receivables means the factoring house will essentially finance the goods through factoring. Now, here's the steps to factoring. Step one, the exporter essentially makes a sale to an importer, and they agree on terms of trade. That is, they agreed essentially that payment will be made in 30 days or 60 days or 90 days and so on. And so an accounts receivable is essentially generated, and there will be an invoice or there will be an accepted bill, bill and so on, that will register that this accounts receivables has been generated. Then the exporter potentially needs cash for some reason, and so the exporter approaches a factoring house and fills out an application to factor essentially their accounts receivables of the importer. The exporter submits all the documents, and the factoring house, of course, will do their due diligence on the importer. And as long as the importer is solid, the factoring house essentially will provide financing. Now, if the factoring house is worried about the commercial risk, worried about the possibility that this importer may not pay, the factoring house may in fact approach then a credit agency like Export Development Canada, an export agency, to help with credit insurance. And what credit insurance does is that the EDC or any other export agency will simply guarantee then that the importer will pay. So it's insurance against default. Yeah. Once that happens, once the factoring house has done its due diligence and possibly got credit insurance, the factoring house then informs the exporter that the application has been approved. The exporter sends the goods over. The factoring house confirms the invoice, essentially. Now, of course, when the exporter sends the goods over, we said the exporter will let the importer know that payment should not be made to the exporter, but instead payment should be made to the factoring house. And so the factoring house confirms that, and the factoring house then issues the check, less the discount, less the holdback, essentially. And then at the end, when the factoring house collects payment from the importer, the factoring house now issues another check for the balance, which is the holdback, essentially, that was made, less other expenses, other interest and fees that may kick in. So that's sort of how a factoring house works. And so often it's a choice. You can say, should I go with the line of credit or should I go with factoring? And one can ask themselves, well, who should use factoring and who must use factoring, essentially? So we're saying in terms of using factoring and the ability to use factoring, I would say it's recommended for an exporter that's going to be exporting goods on a continuous basis, essentially. So on a short-term basis, for instance, if you have a contract with Walmart, you produce some sort of hand cream here in Alberta, or some sort of soap product that Walmart is willing to sell on their shelves in the United States. Then on a short-term basis, you'll be sending these goods over every 30 days and so on. And this would be a good time then to perhaps get into factoring. It is particularly attractive for SMEs, for small and medium-sized enterprises, because what factoring does is it provides a steady stream of cash flows to you that essentially allows your cash flow cycle to become quite stable. Now, who should not use factoring? Well, first of all, if you're new to exporting, and this is your first time of doing it, not only should you not use it, it's very unlikely that the factoring house will actually allow you to use it. And one reason is that the factoring house, one, doesn't take on clients for a one-time deal, so they don't know if this is going to be a continuous thing. And factoring houses like continuous exports, where they provide factoring on a continuous basis. And the second thing, of course, is that the factoring house also requires access to a certain volume. Ideally, they'd like to be able to finance all your accounts receivables, but they require a certain volume of your accounts receivables to finance. So not just to one client, but if you have several importers, several trading partners, they essentially would like to factor to all of them. And the reason they like this, okay, is the following. If the factoring house allows the exporter to choose when and whom they essentially decide to factor, so they get to choose that this particular trading partner, we will give you the accounts receivables, but this particular trading partner, we will keep the accounts receivables, and so on. Then there's what's called a moral hazard problem. That is, the factoring house knows that the only accounts receivables they'll tend to get are the accounts receivables that are kind of shaky. And so to avoid that, they want essentially accounts receivables on a continuous basis, and they want all the accounts receivables, or at least a certain volume of them, on a regular basis. So that's sort of it for factoring. One can summarize the advantages for factoring as: one, it increases the liquidity of the firm and provides stable cash flow. Two or three, shall we say, it eliminates currency risk in the sense that the exporter, once the exporter has essentially factored the accounts receivables, they don't have to worry about payment in 30 days or 60 days, and the currency risk that comes with that payment, that becomes a problem of the factoring house now. So it shelters them from interest rate fluctuations. That is, if they went with a line of credit, then the line of credit then is short-term interest rates. That is, as the prime rate goes up and goes down, the amount you pay on your line of credit goes up and goes down. With the factoring house, there isn't that fluctuation in interest rates and so on. It eliminates collection. That is, the factoring house has to engage in the collection and so on. And the factoring house is the one that will be worried about credit insurance. All these things are taking away, all these, shall we say, non-essential transactions or non-essential managerial issues are taken away from the exporter, and the exporter is allowed to focus on what they do best, on the production or the operations that they do best. And so it gives an optimal use then of the exporter's resources, as opposed to these other, shall we say, transactions or other issues that it normally may have to deal with. Disadvantages to factoring. Well, one is it's only possible then in countries which have essentially laws that can support this buying and selling of receivables. Essentially, for a country to have these, the country needs to have well-established property rights, okay, where if the factoring house needs to go after the importer to collect on this account receivables, there is a court system in place and so on. There are judicial processes in place that allow for this to happen quite easily. And so for many lesser developed countries, many, for instance, former Eastern European countries, and even Russia, for instance, many factoring houses are not willing to essentially do business in these countries. Factoring is a short-term financing method. So essentially, it's for 30 days, 60 days, 90 days, up to a maximum of 180 days the factoring house will do. It's very expensive. We mentioned that before compared to other kinds of short-term financing, particularly lines of credit. And another downside to factoring is the potential loss of credibility. Often, if you use a factor, then the signal you send to your trading partner is that you were unable to get a line of credit. And so you had to resort to this factor because there's something about your credibility that's about your creditworthiness that's a bit shaky. So you want to sort of be aware that this may send a signal to your trading partner that you are not as reliable as they may have thought. Okay. Having said that, the World Bank, for instance, is certainly pushing a lot for factoring these days. Let me see here if I have this here. So here, for instance, is an article by the World Bank that speaks then of how factoring is becoming quite important then in financing small and medium-sized enterprises and global growth. So it's becoming more and more popular, and the World Bank is encouraging more and more countries to establish legal systems to support factoring because it really facilitates international trade. Where can you find a factoring house? In Canada, here are some, globally speaking, FCI, the Factor Chains International, they're probably the first place you should go to find a factoring house. They also work with the World Bank to essentially promote factoring a lot. So that's it for short-term financing. Now, when it comes to medium-term financing, essentially, we can look at some methods. Before we get to medium-term financing, there is one method of financing that I want to mention, and that is the purchase order financing. So it's similar to factoring in the sense that the exporter, the seller, essentially is going to sell an invoice essentially that they have. But in this case here, the invoice that the seller is going to sell is not an accounts receivables, but is really then just a purchase order. So it's really a purchase order. So what happens then is that the financing agency essentially is what they do is they essentially buy goods and they will be the ones to sell to the purchaser. So purchase order financing is useful. So a seller, for instance, has now an order to manufacture goods and send over to an importer, but the seller may be having trouble just obtaining the financing to do the manufacturing, and so the seller essentially, instead of struggling to do that, will really sell the purchase order to this financing house, and the financing house essentially will be the one to complete the manufacturing and send the order and sell the goods over to the purchaser. So that's what the financing agency does. They buy the order themselves and they arrange to complete the manufacturing and to sell it to the purchaser. So it allows then financing at a very early stage. It's not used on a continuous basis. It often is used in extraordinary times. It's even more expensive than factoring. So I thought I would just sort of mention that. That's a possibility that's out there. And now we can move to medium-term financing, and very similar to factoring again, one of the most popular methods for medium-term financing is then forfeiting. And forfeiting is the discounting of medium-term promissory notes or promissory drafts, so bills of exchange that are related to international trade transactions. Okay, and that's forfeiting. Difference between forfeiting and factoring essentially is forfeiting deals with one-time large specific transactions. Generally, they involve capital equipment or capital goods like medical equipment. And then, of course, the term is longer. So factoring is financing for 30 days up to 180 days. Forfeiting is financing from 1 year up to, say, 7 years. So you essentially, it's medium term. Of course, after 7 years, you get into long-term financing, and we're going to discuss that in the next lecture. So how does forfeiting work, or what are the advantages, shall we say, of forfeiting? Well, once again, as in most medium and short-term financing, it offers you cash upfront, okay, quick sort of cash. So it helps you close then that cash flow gap, that cash conversion cycle gap. So from the time you're sending the goods over to your trading partner overseas, till when trading partner pays you, there is that gap. And for these large capital goods that are fairly expensive, that gap can be quite in a few years. So it's difficult sometimes to ask your trading partner to pay, say, a $2 million invoice in 30 days. Usually you'd give them a year and a half and so on. And the way you do it then is you collect an invoice from them and you sell that invoice then to a forfeiter. So it eliminates then the need to obtain export credit insurance directly. That is, instead of you worrying about the importer paying you, you leave that up to the forfeiter and so on. It also, just as in factoring, eliminates the problem of collection, eliminates the problem of foreign exchange risk, eliminates some interest rate risk. Now, whereas factoring has that 20% holdback that's there, so you only get about 80 to 90% upfront. With forfeiting, you generally will get 100% of the invoice upfront and so on. And so it's a fairly flexible method of financing. So here's how the process works. The exporter and the importer start negotiations, and they agree then on a contract price on a period of credit, so a year, 2 years, 3 years, 4 years, up to 7 years, which is a medium term. They also agree then on the kind of interest rate that might apply in terms of the terms of trade. So if they're giving you a year and a half, 2 years, and so on, the terms of trade will include some sort of interest rate for that period. The exporter then approaches an overseas forfeiter, and they do this then usually through, again, an export credit agency like Export Development Canada. And they take all the relevant details of the transaction, and they get a quote on this forfeiting, and they go back to the exporter with it. Okay, and they essentially go back to the exporter with the quote. Sorry, I meant they go back to the importer then with the quote and with the offer. And so you may notice that the exporter here that was here has changed now to now say importer, which it should have said at the beginning. But now the exporter and the importer finalize the terms of the contract, taking into account how much the forfeiter is going to essentially charge, and they build that into the price then of the contract itself. And so all discounts and other charges are then loaded into the basic contract value between the exporter and the importer. Okay. So next thing, then the exporter exports the good. Exports takes place. Shipping documents, the bill of exchange, and so on, promissory notes. These are sent then to the importer's bank in whatever format is necessary. And then the importer's bank essentially gives those shipping documents, the bill of exchange, the bill of lading, and so on, to the importer in exchange then for a promissory note. So a promissory note is simply an IOU that the importer will sign, essentially saying that I will make this payment of 2 million or 3 million, and so on, or in the next 100 or next 18 months, next 2 years, and so on. And the importer's bank essentially may actually provide an additional guarantee on this, and so on. So the exporter gets the bill of exchange, which is stamped with acceptance, gets the promissory note as well as the bill of exchange, and it's endorsed with the words "without recourse." And by this, essentially, we mean that if the importer doesn't make good on this, if the importer defaults on it, then the exporter has nothing to do with it. So all forfeiting, shall we say, is done without recourse. And they give this to the exporter, and the exporter presents the documents to the forfeiter. Once they see that promissory note from the importer and so on, the forfeiter discounts the promissory notes according to the predetermined rate. So just like in factoring, forfeiting essentially is discounting. So you will take the $2 million and so on, and if the interest rate is 5% per year, you would discount that back today, and so and that's essentially how much the exporter is going to get, less, of course, any other fees that may kick in. Okay, so and then the exporter the bank credits the amount and so on. And so in a year, in 2 years, whenever the invoice stated, the forfeiter will present the documents to the importer and receive then their payment. And that's sort of how forfeiting works. So we can see that forfeiting and factoring are fairly similar. They essentially have a house that will take either an accounts receivables in the case of factoring, or a promissory note, which is kind of like an accounts receivables in the case of forfeiting, and then we'll discount that back based off some fees, and the exporter, the seller, essentially will get their money up front. So we can ask ourselves, though, what's the difference between the two? Let's compare and contrast factoring versus forfeiting. And so here is a comparison then between factoring and forfeiting. First of all, factoring is suitable for an ongoing open account. That is, we're saying factoring is generally only done if the sales are happening on a continuous basis. Every 30 days, the exporter is shipping stuff over and generating an accounts receivables. And so that's what factors like. On the other hand, then, forfeiters generally are oriented towards a single transaction, backed by essentially a letter of credit or a bank guarantee from the importer's bank. In a matter of the term of the financing, factoring is short term, 30 days up to 180 days. Forfeiting essentially is medium term, anywhere from that 180 days up to 7 years. Factoring requires a continuous arrangement between the seller, the client, and the factor itself. Forfeiting doesn't. Usually then it's a one-time deal, so it's a single transaction. In terms of the size, then forfeiting usually tends to be larger. Factors assume responsibility for collection and so on. Forfeiters, they do assume some responsibility for collection, but it's for that one-time transactions, whereas the factor essentially will assume then responsibility for collection on a continuous basis. Here is a list then of the charges that apply for factoring versus the charges that apply for for forfeiting. I'll just skip on from that. These slides are on Blackboard. You can take a look at the list and so on as well. Factoring, we're saying then, is available for domestic trade as well as international trade. Forfeiting usually is available only for international trade, and usually forfeiters prefer to deal in countries where the currency then is freely convertible, that is a floating exchange rate. Factoring can be with recourse or without recourse. Forfeiting is always without recourse, essentially. And then factoring can be small transactions, medium-sized transactions and so on, where forfeiting tends to deal only with fairly large transactions. Anything under $250,000, usually the forfeiters are not interested. So that's sort of the difference then between factoring and forfeiting. Factoring is short-term financing, forfeiting is medium-term financing. The last thing I just sort of to speak about then here is another form then of short to medium-term financing, and it depends on the negotiation terms. And that's what's called then negotiated import financing. I'm not sure what that's doing there. So negotiated import financing then is where the importer essentially decides that they will obtain financing and pay the exporter payment in advance. And so usually then these are short-term loans that are negotiated between the importer and the importer's bank, and they are made to match then the product or the service. They could be sometimes on a continuous basis, but often negotiated import financing is on a one-time basis where the importer decides to finance it upfront. Now, why would the importer do that? The answer, and we've said this before, if the importer, for instance, is able to get better terms of financing, they're able to get better competitive interest rates on the financing, they're able to secure bigger amounts on the financing than, say, the exporter are, they're able to get better flexibility in terms of the length of the terms and so on, then the importer, it's to her advantage to essentially get the financing and pay in advance, because usually all these costs of financing are built into the price, the landed cost of the product. So that's it. Now, of course, import financing does not solve the foreign exchange risk problem for the importer. So it does allow for currency fluctuations. So sometimes then the import financing will take into account currency fluctuations, and there may be an agreement between the importer and the exporter then on how they split the foreign exchange risk. But that's import financing. It's a negotiated way of financing short-term loans when the conditions are right. So that's all for this lecture. The next lecture then will deal with long-term financing, especially for foreign direct investments. And so yeah, we'll see you then.